Are y'all ready?
Yes.
Good morning, everyone. I just wanted to go ahead and invite everyone into our presentation on new market tax credits. This webinar was set up to basically give us some information concerning the incentive and the benefits of this particular incentive. I've been able to assemble a panel of experts that can basically give us all the information that we need on new market tax credits. I wanted to let everyone in the audience know and the listening audience know that we are going to have this presentation recorded. It's being recorded as we speak, and those links will be sent out to all the registered participants at some point after the webinar has been concluded. We're fortunate enough to have these experts here on a panel to be able to talk about new market tax credits. I'm going to go ahead and introduce the panel of speakers that will be here today. We have Eric Voiles, who is TexAmericas Center Executive Vice President and Chief Economic Development Officer. As I mentioned, I'm Andrew Hill. I'm TexAmericas Center Vice President of Finance. We also have Ashley Wicks, which is a partner in Butler-Snow, LLP. And we also have Monica Blanton from BrightBridge Capital. She's the Director of New Market Tax Credit Operations. We're going to go ahead and get our presentation started off with Eric Voiles, and he's going to give us a little information concerning TexAmericas Center.
Thank you, Andrew.
All right.
TexAmericas Center is kind of an interesting economic development organization. We are what's called a local redevelopment authority. So we are a special purpose district of the state of Texas. Our mission is to redevelop the 12,000 acres in Bowie County, Texas, which is part of the Texarkana metropolitan area. Former military property. We and our partners have spent over $70 million to get the property to a point where we can transact. And so we've actually moved to a phase where we have well over 2,000 completely infrastructure served, shovel ready property. We have 3.5 million square feet of existing space on the property. We've also added several different forms of service, many you don't find from a traditional economic development organization. So we can lease buildings, we can sell buildings, we can do build to suit and lease, we can do build to suit and sell, we can do build to suit with a long-term lease. And we can even do a reverse build to suit if the conditions are correct and appropriate. We have a logistics division. We have the ability to provide third-party logistics. We found that a lot of companies, as they are looking to establish a first-time investment in Texas, really like to work with us on the 3PL component because we can help them get their initial operations up and running while they are still yet working to get their entire business actually set up and operating. So we can receive product, marshal it, and push it out. And we own 38 miles of rail. So we have a rail division where we can do transload, we can do spotting, and we can do storage. We manage incentives. So just like we're talking about new market tax credits here today, we work to get all of our property eligible for certain federal, state, and local incentive programs. And then we work with our partners to help educate and make people aware of how you could use that incentive on our property. And then finally, we can assist with financing. For our build-to-suits, we do all the financing through the organization, and then you just lease or purchase it directly. But that's a little bit about TexAmericas Center. I appreciate the opportunity to share that and be a part of the group. Back to you, Andrew.
All right. now it's time for the meat of this presentation. Like I said, we're honored to have Ashley and Monica on. We worked with them in different capacities here at TexAmericas Center, and we really appreciate them taking this opportunity to go out and speak to this group today. So I'm gonna turn it over to you and Ashley, Monica.
Ashley, you want to introduce yourself first?
Sure. I'm Ashley Wicks. I'm a partner with Butler-Snow. We are a full-service law firm throughout the Southeast. We do transactions all over the United States. We do a lot of new market tax credit transactions, which we're discussing today, but we do also other alternative financing or development financing. And that's briefly who we are. My contact information will be shared at the end of the slide. So if you want more information on myself or our firm, please feel free to reach out.
Great, thank you.
Okay.
And I'm Monica Blanton. I work with BrightBridge Capital. We're located in Tennessee, and we are a nonprofit commercial lender, a commercial gap lender. We're not out there competing with banks. We help banks get projects done. And some of the tools we use to fund this gap would be some SBA lending, and new market tax credit lending, which we're going to talk about today. I've been working in the new market tax credit space for longer than I care to admit, like almost 20 years, and I work in it in different ways. We apply for new market tax credits, so sometimes we have our own allocation to deploy, and we also provide new market tax credit consulting, where we help projects understand new markets, understand how it might benefit your project, help you analyze to determine if it would be a good fit for your project, and help you understand what the net benefit is, and then would help you get allocation into your project. So new market tax credits, let's go dig into those a little bit. I'm sure all of you have big ideas for great projects and that would have a positive impact on the community, but you might have a project shortfall, and that is where new market tax credits might come in to help. We're going to talk today about how the program works, what does it take to get it, and what benefit does it provide. And we're going to try and talk at a really high level here, just so that you can understand these concepts, but you know, you're not going to be able to go out and close a new market tax credit transaction right after we finish this. But if you can, you're a better person than I am. So how do they work? The program was put into place about 20 years ago with the goal is to attract private capital into low-income communities. And a low-income community is based on economic demographics at the census tract level. So there is a limited annual amount of new market tax credits, which makes it competitive. And I coined this phrase from Ashley, that it's a beauty pageant kind of among projects and among CDEs to get this allocation into a project. So a CDE is an entity that is certified as a community development entity, and they're the ones who apply for new market tax credits and then control it. And talking about new market tax credits here, the benefit provides just a portion of your project financing. It's not going to finance your whole project. It might finance, you know, in the 15 to 20% range. Would be financed into your project and potentially forgiven at the end of the new market compliance period. So we try to not use too many acronyms, but we just can't get away from it because there's a lot of mouthfuls in the terms we use in here. So throughout the presentation, the NMTC stands for New Markets Tax Credit. The CDFI fund is a department of the Treasury, and they're the ones that control the new market allocation and run the program. As I mentioned before, the CDEs are the community development entities. They're the ones that we apply to the Treasury Department for New Market Tax Credit Authority, and then we pick the projects to fund with it. And LIC is the low-income community, the census tracts. They're their economic distress characteristics are based on the census data. So right now we are using the 2020 updated census data to determine if projects are in an eligible census tract, which we know TexAmericas Center is an eligible census tract. And if you're looking at other projects, there are mapping tools out there that you can use to map a project.
Monica, one of the things I think is important to point out about the tax site is that it's not only qualified based on its location itself, it meets several of their, that we call them, their additional criteria to be considered highly distressed. So under the beauty pageant idea, these are the things that make you a top 10 finalist. And they meet several of those criteria to be a top 10 finalist. And I think that's when you're thinking about locating your site, or you're thinking about opportunities and whether or not your site can attract new market tax credits, they're considered severely distressed because they have those additional factors that that CDEs look for.
Yes, because the beauty pageant part of it applies to CDEs when we're applying to the Treasury Department for a tax credit authority, because again, it's competitive and there's a limited amount. So CDEs will say, we'll do the hardest stuff imaginable, just give us the tax credits. So most of them will commit to funding projects that are not only in eligible census tracts, but highly distressed. And this highly distressed comes from either higher economic levels of distress or additional criteria that Ashley was referring to. The project sponsor is the project owner, and the QualiCB is how we pronounce this acronym here, and that's actually the borrowing entity, which might be slightly different from the project sponsor, you know, if you set up a special purpose entity to own the real estate. So one difference in this tax credit program from a lot of others, there's a couple differences. One is the new market tax credits don't belong to the project that it's going to here. The tax credit authority is given to those community development entities to go out and raise capital to put into qualifying projects. And so that's one big difference. You know, the project doesn't own the tax credits or control it. And another one is the allocation doesn't equal cash. The allocation that we will talk about, that is the qualifying project cost, or the amount of capital that's going into a project from which the new market tax credits are calculated. So the tax credit benefit is less than the allocation amount.
So I know that we're giving you a whole lot of information, and we want to make sure that this is informative to you guys. So if at any point you have any questions, please feel free to use the Q&A function of the webinar. And just if you have any, because we know it's a lot, it's a different type of program. There are new terms, there are new acronyms. So please feel free to use that function, because Monica and I like the interaction. We like questions.
Yes, we do. Okay, so the community development entities that control this allocation, again, their mission is to provide investment capital in low-income communities. That's how you get certified. And they control the allocation, which means we apply to the Treasury Department for it. We select the businesses that we're going to fund, and then we raise that capital by selling the tax credits to the investors, the people who are going to use the tax credits against their tax liability. Those are typically banks. And then with that money, we take it and we make a loan to the businesses with it. Again, there's a limited amount, so it's competitive to be selected. So I mentioned the tax credit investor. That investor has nothing to do with your project other than the fact that they are buying the tax credits. They want to make sure that they realize all those tax credits over the 7-year compliance period. So there will be some guardrails put on the transaction structuring to make sure that they get those tax credits, but they just use the tax credits. They are not an investor in your project. So they purchase them from the CDEs. They get to take the tax credit off their tax returns at a specified rate over a 7-year period. They're currently buying them for, 78 to 81 cents, somewhere in the market right now. And their main concern is to avoid recapture. So they want to make sure the project qualifies, that it stays qualifying for those 7 years, and that all regulatory criteria are met. And that's where, that's one of the great benefits of having good attorneys that really understand this process, and they help you set the project up and the financing so that all these criteria are met.
Monica, we did receive a question. Can you give me some examples of beauty pageant winners? What are the common characteristics? So
Go ahead.
that's the question.
Okay, so yes, we're going to talk about that in a minute. Like what, but so the CDEs, you have to qualify. You have to be in a qualifying location, first of all. And so that's just a given. We can take that off the table. So then what the CDEs are measuring and comparing is your project ready? Do you have your other sources of revenue? Do you know how much your project's going to cost? So you got the state of readiness and that you have your leverage. Then they're looking at the impact that your project has. So each CDE has their own criteria they're looking at. Some will focus on job creation, some might focus on healthcare, some education. So they'll just quickly scan your project and see if it meets their criteria, and then dig down into, okay, if you're creating jobs, how many jobs are you creating? How many of those are accessible to people, to low-income people? If it's healthcare, how many people are being served, and how many of those are low-income people? So there's a common theme here of how much benefit is it bringing to the low-income community? Is that measurable and quantifiable? And needed in the communities. So examples, I have just closed a rural hospital that's being rebuilt, that really had a need for this tax credit with the extensive increase in construction cost in order to get this project done. We've closed manufacturing expansions, charter schools, a lot of different types of projects. Do you have any you want to provide examples of, Ashley?
So I've done, recently I had a mixed use development. Some of it was office space. There was a rural urgent care facility at the bottom. There are some, when we're gonna get, like Monica said, as we go through this part about what does it take to get new markets into your project, we'll kind of flesh that out a little bit more. But the thing we like about the program, and the thing to remember broadly, is it's intended to support or help projects that are commercial in nature, projects that provide services, as opposed to a LIHTC transaction, which is more focused on housing. We're going to kind of flush some of these things out in this next section. So what does it take to get new market tax credits into your project? Okay. So it's about location, the commercial location. You want to make sure that you have a qualified activity. And as Monica mentioned earlier, the CDEs have they're applying for these tax credits. So they want projects that have great community impacts. And so we're going to discuss that a little bit more, flesh that out a little bit more. So geographic restrictions, businesses located in low income community, you can Google different mapping tools. You can go to the CDFI fund, they have a mapping tool. Novogradic, which is an accounting firm, has a mapping tool. CohnReznick, which is also another accounting firm, has a mapping tool. And what you will do is you will put in the location of your project. One thing to remember is this is driven by census data, and censuses are taken every few years, and the information is being updated. So we're in what we call right now a transition period. So you want to look to see if the project qualifies under old census data. If you think you can close it before the end of August, I think that's the deadline, August, right, Monica?
Yes.
End of August. And then if you think it's a project that is not far along and that can't close, which most likely most of your projects will be, right? So you want to look at the new census data, make sure that it's qualified. So that's the first step, because if the project doesn't qualify based on location, we could focus on targeted populations where we look at your employees, we look at who your services are, but those types of deals are harder to do and sometimes harder to get allocation for, because they require much more compliance to make sure that they do qualify. So that's just something to keep in mind. The low hanging fruit is to locate it based on the census tract. And because, you're considering the tax site as a possible location, you have half of the battle right there, because it is qualified and it is severely distressed. So that's like 10 bonus points, right? The project itself must stay in the census tract for the full 7-year compliance period. This is not the type of thing that you're gonna get in, do the financing and move and relocate, right? So you have to be committed to being there for the 7-year compliance. Okay, so that's a good question. And the question is, what is the time frame to receive new market tax credit benefits from start of the process to finish? And we're gonna answer that question a little bit later as we go along. So I'm gonna I see your question, I'm gonna flag it, but we're gonna talk about timing, ready to go, readiness, and the things that you need to do to prepare for it. But just to give you just from a timing standpoint, Monica, I would say anywhere from maybe 6 to 9 months, 6 to a year to close, 6 months to a year to close.
Yes. I mean, depending on the project state of readiness, but I'm working with one project that I can't remember if I started with them in December, around that time frame, or maybe, oh no, it was the end of October. And we are just getting ready to start a new market closing at the end of this month and hope to be closed by the end of June. So yeah, it really depends on your state of readiness on the project. Again, if you have your leverage, if you have, how much your project's going to cost, you've got your contracts, all that type of stuff. And if you have all that, then it might be 6 to 9 months. It kind of depends on when you jump into the new market cycle. It depends on a lot of different factors, but
and this will make more sense as we put the pieces of the deal together. So Courtney, we're probably going to give you a lot more context as we go along. Okay. So is it qualified? Is it a qualified business? That's one of the criteria. And so these are activities that are ineligible. Remember before I said this is not LIHTC. So the idea is that you're not going to use this to do a full-on housing development. Now, can you rental housing development, right? So can you do a mixed use facility? Yes, but we'll need a commercial component that generates at least 20%, over 20% of revenue from commercial tenants, right? The reality is, because the threshold is 20%, most CDEs will require a higher amount of revenue from the commercial space, usually around 30%. That's the practical aspect of it. There needs to be some substantial rehab, or it has to be owner occupied. If it's a straight acquisition. And then there are certain businesses, we refer to them as sin businesses, whether or not they're sin or not. But these are the businesses that we can't finance. We can't do racetracks. We can't do gambling facilities. We can't do golf courses, country clubs, liquor stores, farming, massage and tanning businesses and undeveloped land holding companies. So the idea is, from the federal government's perspective, is they want this money to hit the streets to create community impacts as soon as possible. So the idea is they don't want this money to sit somewhere. They want it invested. One thing I will clarify, so we can't do a liquor store, but that doesn't mean we can't do a restaurant or a grocery store. We can't do just a standalone wine and spirits store.
Okay, so,
Go ahead, okay. Go ahead.
let's
I'm gonna
see.
let you.
I think we skipped, something. Did we skip a page?
Something skipped.
Oh, no. Let's see here. Maybe I just skipped.
So we're gonna talk about community outcomes.
Yeah,
We're gonna
you go
take this
ahead.
one.
Yeah, go ahead. Oh, do you want me to? Is that what you said?
You can go ahead.
Okay, sorry. Okay, yeah, we talked about, this is one of the subjective criteria when people are looking at new market tax credit projects and the community outcome. So is it tangible and quantifiable? How many jobs are you retaining? How many are you creating? You know, is quality jobs an issue in the community? Or if you're doing a healthcare project, you know, is there a lack of access to healthcare? So does it address that community need? And so some specific examples, as we talked before, are the jobs accessible and quality jobs, meaning they pay a living wage, might have benefits, providing economic stability and opportunities for growth, training, et cetera. Or you might be providing goods or services, commercial goods and services. For instance, grocery stores in low access food areas are a popular use of new market tax credits. And then there's other impacts that people are looking for and measuring. Some CDEs, you know, there's one that focuses on environmental impacts. So whether that's, you know, cleaning up a brownfield, and then the industry itself might be providing something more friendly to the environment than alternatives. So, so the community outcome, it's very important to have a handle on that and for it to be something tangible and quantifiable.
Okay, so if we look at the project checklist, we talked about is our project located in a designated low income community? Check. We check the box. If we're locating on the tax site, we qualify. Is it a sin business? No golf courses, no massage parlors, no liquor stores. Do we create tangible community economic benefit and outcomes? And those are the things that Monica mentioned earlier. And those are the things that CDs are looking for. What kind of story can you tell about your project? And some projects may be catalytic, may be the beginning of something bigger for their communities, especially if it's a community that is driven with blight. And I think one of the things that I like about the tax site, you know, it was in its heyday one of the, like, a booming community for that area. And one of the reasons you're on this site and the work that TAC is doing is to make it again a booming area, providing services, providing amenities for, you know, the surrounding communities, kind of like what it was before, by bringing jobs, not only jobs, but certain amenities to the community and some workforce development training. So as far as new markets go, there's a great story to be told there. Now, project size, we haven't really talked about that, but usually you want a threshold amount of $5 million, at least a $5 million project size, because there are a lot of players. There are some costs related to doing a new market tax credit project. And usually at $5 million, your net benefit to your project is about $1 million. And that's kind of where most projects see it's worth going through the exercise of doing a new market tax credit transaction. So, Monica, do you want to do this one or you may go?
Sure, sure. So this kind of gets to the question about timing. Well, you asked how long it takes. And so this is related to that. Like, when should you start looking for new market tax credits? And that, my answer is always, it's never too early and it's never too late. As a CDE, we are always looking for projects in our pipeline, some that we might want to give as an example in our application, which we submit our application for new market tax credits a year before we ever are told if we get it or not. So we like to have projects, that are more, less formed, they're more an idea that we would put as an example in there. And then when we're awarded allocation, we go back to those projects and say, hey, are you ready? What does your project look like now? So there's that aspect, and we're always looking for it.
Monica, as I know that you all are our CDE, but you all provide like consulting services. And as
Yes.
part of those consulting services, if a project comes to you early on, you can help them put the pieces together and kind of shepherd them through that process, right?
Exactly. Yes. And help them understand what things CDEs are looking for, and by no means do we want new market tax credits to run your business, but there might be certain things that you're considering, that make your project more attractive for new market tax credits. So we're always happy to share that knowledge.
And then, even if you don't get allocation, you can identify other CDEs to help them.
Exactly.
Right.
People are always out there looking for projects, and we, it's a relatively small universe of CDEs, and most of us working in the industry know what other CDEs are looking for, who's interested in what type. We've got close friends, we might know who has allocation, who has something drop out that isn't ready. So that's also when it's never too late. Your project might really already be started. You've started moving ground, and you have a leveraged loan, you have a loan for the project, but you could use a little bit more. Like if you got this additional money, you might have more working capital available. Your business would ramp up sooner. You might add another piece of equipment or whatever, because a lot of times we might be trying to close a project, or a project falls out, and CDEs are out there looking at the last minute when they have allocation for a project to close. So the new market tax credits can envelop the financing that you already have. It doesn't have to come in before you start your work on your project. Now, how do you find CDEs? So through the industry, Ashley and I can help you find CDEs that are out there. A lot of banks, a lot of the large regional and national banks work in new market tax credits. So your bankers might know, they might do the new market tax credits themselves. And a lot of the bankers might not be aware that other people in their bank do this, but that's one way to find it. The industry service providers, the accountants, attorneys, they're aware of CDEs. A lot of economic development professionals, like your great people here at TAC, they understand about new market tax credits, and they're exposing you to it. And then also through the CDFI website. So, and there are just different levels of interest that a CDE might give you. They're interested in your project, want to learn more about it. They might put you in their pipeline. That doesn't necessarily mean you're going to get allocation, but it's a good indicator of a high level of interest. And then they might highlight you in their application, and when you really have allocation is when you get an allocation commitment, that's when you're going to have it. You want to talk any more about that? Any of those other things there?
No, I'm just trying to figure out how to move the slide.
Okay, so now let's talk about how much benefit that brings to the project. This is the good part here. So common terms of what the new market tax credit equity does is it comes in, all the cash comes in on the front end. When we close a new market transaction, you get that money. Now, I will be a little bit more conservative than Ashley. I think in a $5 million transaction of new market tax credits, your net benefit might be more in the $600 $600,000 range, maybe 600 or a little bit more after the closing cost, but that's still great. Like if I had a $5 million project, I'd love $600,000 to be given to me to help that project. So it comes in on the front end. As soon as your new market tax credit closing happens, you've got that cash to either, you know, do your construction, buy your equipment, whatever it is you need. And it's very low interest rate. So this tax credit equity, it can't be a grant because of the way the law is written. So on the front end, it's not a grant. It is structured as a loan, but it's very low interest rate, like 1%. So again, in this environment, love to have a 1% loan. So for 7 years, all you do is pay 1% interest on that. You don't pay any principal on it. And at the end, it's typically all forgiven. You would know at the beginning what the terms are going to be, if it's going to be forgiven or not. And so this net benefit here ends up funding, you know, 15 to 20% of your project, and it's paired with your other sources of funding, your equity, debt. It pairs with a lot of other incentives. And when I talk about that it would yield, you know, 600,000. So that 1% interest rate, I've already calculated that in my head, you know, so kind of as a use of the funds.
Monica,
Yes.
going back to the other slide, at what point are the funds actually able to be secured? Does the project need to be completed and operating, or can the funds come in before construction is complete or even before construction occurs?
So B and C there, they don't typically come in. You typically don't have a new market tax credit financing after the project is done, because as part of this, the project is supposed to have a need for the tax credit. So the CDEs are going to say, you know, what is your need? What would you do that's not going to happen without these tax credits? So, so it can come in depending on when you get that allocation committed, you know, the money would come in, it comes in at new market closing. So that closing could be before you start construction or during construction, you know, or, you know, before your expansion, before you've bought, you might have put deposit down on, you know, a $20 million piece of equipment that it's going to help you, the new market tax credit will help you get that equipment installed and provide working capital for the people you're going to need, you know, to run that equipment. So it's not as common to see it come in after financing.
And one thing to point out, that's if we're thinking about this as a real estate deal, there are some things you can finance for operating an existing business to generate additional working capital for an operating business, which is a little bit different. But if you have a business that's already located in a low income census tract, and there are some operations that we want to, I guess, monetize or help us generate the credits, we can also use it for that too. But we've been primarily thinking of these deals as real estate deals.
Right. So the new market tax credit is a really flexible tool, which kind of makes it less standardized, the closing. You know, it can be used for for-profit businesses, nonprofit businesses, and it's flexible as to industry and type and uses. It can be used for acquisition, construction, equipment, working capital, and, you know, the new market tax credit equity, what the tax credit investor has paid for the tax credits, that is used to cover the project financing and professional fees, the closing fees basically associated with it. So here is how the math works, kind of on the next slide here, about how you calculate the next benefit. So in this example, let's say there is a project that costs at least $10 million of eligible project cost, and you get $10 million of allocation committed to it. So the tax credit rate over 7 years that the investor is going to get, which is, you know, in the law, is 39%. So you multiply 39% times the 10 million allocation, and that investor is going to get $3.9 million reduction in their tax liability over the next 7 years. So they're not getting that today. So they're not going to give you $3.9 million to get a tax credit in 7 years. They're buying this at a discount. And at 75 cents, which right now the rate's a little bit higher, but in this example, they bought it at 79 cents, which yields tax credit equity of $2.9 million. So they're paying $2.9 million, the investor bank is, and they're going to get $3.9 million over 7 years. So this accounts for the time value of money, and that gets them all the financial return they want on this $2.9 million. So at the end, investor will walk away from the tax credit because they will have earned $3.9 million on their $2.9 million investment. Then there are estimated closing costs and fees. These are CDE fees and legal fees. You know, everybody in this transaction has an attorney representing them. So the CDEs, the borrower, the investor. And I would say the majority of this is really the CDE fees. And this is represented by some fees that the CDEs take up front, as well as that 1% interest rate over that 7-year period. And that's the only return that the CDEs get. So I would say CDE fees average in total somewhere in the 9 to 9.5% of the allocation, the $10 million up there. And CDEs, the reason they charge that is we're working with that allocation for a 10-year period. By the time we apply for it, we receive it, we deploy it, and then we report to the fund and service the loans for 7 years and then exit and do what we have to do at the end. So that works out to be, you know, roughly 1% a year that the CDEs are earning. So when you take away that 1.4 million of fees from the 2.9 million of tax credit equity, you end up with $1.5 million. So on a $10 million allocation, that is the estimated cash to the project. Now those fees can vary. The legal costs vary really based on the complexity of the project. You know, how much real estate's involved, how many different entities, a lot of different factors, just how complicated a project can be. You know, if you've got other incentives, sometimes that's tricky to make all the terms work together. Do you have anything you want to add on that, Ashley?
No, the only thing I would want to point out is the 39% is statutory. So it's you take the allocation, multiply it times 39%. The pricing, the 75 cents, as Monica said, that is probably higher now, closer to 80 cents. That's market driven by the investors. That's driven by investors' appetite. That's driven by things that may be happening in the market. And that also could be driven by the type of project that you have. If your project has a lot of community benefits, if your project is something that is innovative, that the investor wants to include in its application or it's in their CRA footprints, because most investors are banks, that may drive up the price of some.
Yes, and I guess I did want to say too, so those fees I talked about, those all come from that tax credit equity. So it's not something that you have to be out of pocket on. They're paid with that. Okay, so in summary, all the stuff we've talked about, just big picture here. The CDEs are the ones that apply for the credits, find the user of the tax credit, and pick the project to fund. Or I guess we find the investor. And then the project, your responsibility is to locate in a qualifying area, provide measurable community impact, and stay qualifying for the 7-year period. As we mentioned before, each CDE has their own strategy. Some of those are geographic. You know, they're looking for projects in a certain part of the country. You know, some of them might be city related, some might be state related, some are just general part of the country. And then the level of distress or the specific other indicator that Ashley talked about, whether that might be, you know, a medically underserved area, a food desert, a brownfield site, etc. That's those other distress indicators. And then some CDEs are looking particularly for non-metro underserved states. Texas is an underserved state. That's another 10 points you get for this beauty pageant. So unfortunately, the TexAmericas site is considered metropolitan. I'm sure you guys could offer rebuttals to that, but but we can't change that. So then each CDE is looking for their own impact as well, whether that tangible and measurable, whether it's jobs created, people served, and whatever specific impact it is that addresses the needs. And then lastly, we talked about that your project would have to verbalize what is the need for the tax credits, which isn't too hard in these days. Every project has some shortfalls. And this is kind of a Venn diagram of what makes the beauty pageant winner. You know, being ready, like having your capital stack, your other sources of project complete, being in an underserved state, a favored industry. We don't have the non-metro circle that we can include in this, but those are kind of what makes a project top tier.
Monica,
Yes.
what about historically high unemployment? Is that a factor?
It could be. There are there's some certain terms that are used, and it's not historically high unemployment. Ashley, can you think of what some of those are? There is
Whatever
one that I
that
know,
federal term
persistent
is, we
poverty
qualify.
counties.
We're considered that. I thought it was historically high unemployment. Maybe I'm thinking of historically underutilized businesses, but anyhow, I know that our area has that high unemployment designation from a federal level.
Eric, when we looked at the site before, when we talked about those extra point factors, those to make you severely distressed, that site is severely distressed because you all can say that you all are I think y'all are empowerment zone, y'all are a hub zone, y'all are a, former military base. So y'all have like, y'all, it's basically like you all get all of the points based on location because you're considered to be severely distressed. I think taking it a step further for the projects that are located on your site, I think they're going to need to be able to articulate how they are helping address some of those needs. So if it's employment, if it's workforce development, are they employing people? Are they employing people at, providing what we call quote unquote quality jobs so that, people can make living wages? Are they, training people, giving people skills and assets? Those types of things are what the projects want to include in their story from a packaging standpoint to these CDEs. Hey, if you give us allocation, these are the good things that we're going to do with it. And while we're better than probably the other project that you're looking at, we're located in this severely distressed census tract, but we're going to do all of these great community impact things.
And in terms of the write-up that's submitted, that's part of the services that your group is doing, or is the company expected to do that write-up on their own?
So it's usually, it depends. So if earlier I mentioned consulting services, and that's what Monica can help provide to projects if they're interested. And so usually the consultant, it helps you put those pieces together. To the extent a project chooses not to use a consultant, then it will be on the project to put that write-up together. So if they retain Monica to be a consultant, she can help put it together, or they could, she can help put that packaging together. That's one of the services that they offer.
Great. And then one of the other questions that I've had as I've been listening to this has to do with the economic impact or benefit to the region. Normally when I hear that kind of a phrase being used involving any kind of an incentive, you're looking at doing either a cost benefit analysis or something like an in-plan analysis. Are we talking about needing to do that level of assessment where you're really doing an input-output assessment of what will occur and what those benefits will be?
No, typically it's more based, I would say that it's typically based on the company's projections. We project to create 30 jobs over the next 7 years or 100 jobs or whatever it is. So, so that's typically what it's based on. And I will say there would be a community benefits agreement that the project would enter into with the CDEs that lays that out in detail, but there are not typically clawbacks, you know, that if you don't create those jobs, the note's not forgiven. That is not typically what happens, but again, you would know that before you entered into an agreement with the CDE.
And again,
And-
kind of going back to the same question as before, most companies don't have that level of understanding of economic or community benefit on their payroll. The consultant that's engaged would be helping them determine that and how to position that in the documents, correct?
So when they're negotiating this community benefits agreement, what we do, and the consultants will work with them on formulating the agreement. They identify things that they can measure. Like they can measure, I hired 50 employees, right? They know that if I hire these employees, that, you know, the range of what they're paying them. And so when we're negotiating that agreement, one of the things that the consultant, and if there's not a consultant, it becomes more of the lawyer's responsibility, is making sure that the project has things that it can measure internally, tangible things, and that it can report on. And it will be required, to your point earlier, to complete annual reports to the CDEs and the investor. Hey, you know, these are the number of jobs we created, right? These are the number of you know, these are the ranges of the salaries. Those are things that they can pull from their books. So it's not looking necessarily on it as on a regional or like looking at the whole tax site. It's them reporting things that they said that they can measure to the CDEs.
Yes, it's much more granular, not and specific and forecasted, as opposed to this is generally what an in-plan report would tell you. It's not typically that type of report. That type of report might be used to verify the results that, hey, this type of industry would typically create this many jobs. So that might be used to back it up, but not, but we really want to know, you know, the businesses should know themselves. This is what we would expect to grow. This is what we've done before. Hey, I know we're getting close here to the end.
Okay.
I'm happy to answer these questions, but the next two slides are stuff, Ashley, we've kind of already talked about, when to search and how to find allocation. I don't know if you want to show a chart, if you want to jump into anything or just answer questions. And
well, we have a case study at the back. And I think what we want to do is kind of walk through that, give you a quick overview of that. And again, our contact information is at the back of this presentation. And, you know, we'll be happy to answer any additional questions. But we do want to kind of put all of the pieces together for you. Don't feel overwhelmed. It takes listening to this. I think Andrew could probably attest maybe 3 or 4 times before it makes sense. And you can reach out to the TAC team, and they could provide you this recording to kind of walk you through it again if you need to listen to it again. But going back a little bit, I just want to make sure that you understand how the pieces are put together. So I skipped those slides, which are kind of things that we've already discussed, as Monica mentioned. So on that slide earlier where the math is, and again, we'll send a PDF out of the presentation to all of the participants. So going back to that math slide, we projected that we'll have about $2.9 million of equity that the investor paid in cash for its $3.9 million in tax credits, right? But remember, this is based on a $10 million allocation. So we need to have $10 million that the investment fund can invest in the CDE. And that's usually what we call the leverage loan. So New Markets is not a way to finance your whole project. It's more of a gap filler. And so when we look at the leverage loan, it's whatever else is in your capital stack. So is any equity that you have, any third-party debt that you already have committed, any, if it's a nonprofit, it may be grant funds, but any other sources that we could take, and as that's already a part of your existing capital stack, we would take the sponsor entity, and the sponsor entity will basically loan this money into the investment fund. So you have your existing capital stack, loan it into the investment fund, and it's combined with the money that is generated from the new market tax credit equity in the investment fund. And then the investment fund will make what we call, for new market tax credit purposes, a qualified equity investment of $10 million into the CDEs. Now, remember, the CDEs are the entity that the CDFI fund granted allocation to. And this investment in the CDEs is what generates the new market tax credits. So under the statute, this is what generates or facilitates there being new market tax credit, this investment. Monica, you have anything to add so far?
No,
Okay.
that's great. So again, here it's $10 million because $10 million was the allocation amount that was committed to this project. So that's how much goes to the investment fund.
So then what will happen is the CDE will make is there's one loan document, but we call them an A and a B loan. They're documented by two different notes. The A loan, if you look on the A side, it mirrors the leverage loan, which was your original capital stack. The B loan mirrors your federal tax credit equity. Again, when you get the presentation, you want to take this slide and the slide that had the math and kind of sit them side by side and look at them to see how the numbers jive. And if you're looking for the leverage loan amount, you just take the allocation minus the federal equity, and it'll give you that $7 million. Okay, so the A loan mirrors the leverage loan amount. The B loan mirrors the tax credit equity. So at closing, you will get $10 million to the project. Now, just to give you context, we have a $10 million, well, and it's probably, you probably have a project, well, you will have a project that's, if you look at the total development cost, it will be greater than $10 million. So allocation does not necessarily mean your total development costs, but so that's something that's important to know. So if you look at from this slide, you'll have $10 million in cash at closing. So when you started off and you had your capital stack, you had already lined up the $7 million. The equity comes in and it'll raise the $2.9 million, and then it flows down to the project as $10 million. Now, remember, there are certain costs that you have to pay in connection with doing a transaction. So for the project on that slide, the math slide before, the net benefit to you or the additional, if you look at when all the dust settles, will probably be about 1.5 million. Now, again, I've said a lot. I live in this world. I know what the acronyms mean. So it may be a lot, and you may have some questions following this presentation. Again, feel free to reach out and ask those questions once you've had a chance to process the information.
Yeah, and we're happy. I can stay on for a little while and, answer any more questions. I know we ran right up to the timing, but we're also happy to get questions after the fact.
And this is just a review of the things that we talked about before, and so to provide you with some initial context of the case study. So if you're looking at it at home, the things that I ran through before, this is another description of the math, and we'll include it in the slide deck that we put forth. And again, this is the math. And this is just to help you when you're looking at it at home. So are there any additional questions? I don't see any new questions in the Q&A.
I
Derek,
just had
I'm
one
good about
other,
answering. Yeah, go
yeah, I
ahead.
just had one other question, and it has to do with the fees. So as someone's trying to understand whether or not they want to pursue the potential for new market tax credits, is there an application cost on the front end, or does this really work where you'll start to work with them, you'll help them understand what the cost structure will be, but at some point they have to decide if they're going to move forward, and then that's when real costs start to incur. Help me understand when dollars start to be expended and how much of those can be recaptured, to help move a project forward.
Great question. You could spend, a good amount of time understanding the program before costs are incurred. It depends on if you're, and Ashley and her firm, I know they will talk to you and help you get an understanding before necessarily you start incurring cost with them. Some consultants require an upfront deposit just to make sure they're not wasting their time. There's a lot of time involved in educating and helping projects walk through it. So some require an upfront deposit, but typically most of the fees are paid out of closing. So as you get closer, most of the fees are incurred once a commitment is made. Then you hire your attorneys, you engage your attorneys and the accountants. The CDE fees are based on closing, and when you get a commitment letter, frequently then a deposit is required to the CDEs that will be used to cover their legal fees if something doesn't happen, if the closing doesn't occur. So that's the answer to that. I don't know if you have anything more clarifying, Ashley.
Well, one thing I will point out, so you're gonna do, if this is a project that you're gonna do anyway, the project that you're financing, you're gonna have certain pre-development costs, right? To get the project ready. So those costs you will still incur like you're getting the project ready. But what will happen is, as long as those costs are within 24 months of closing, we can capture those costs in the new market tax credit deal. So we can get you we can either treat them as equity to the project. We can get some of the fees to reimburse through the project. So there are things we could do to kind of capture those pre-development costs that you're incurring to get the project ready. The key is one, figuring out your project, make sure it's located, which we don't have a problem because we're using the tax site. The two, identifying your funding sources, your capital stack, and what that looks like. Three, identifying your community impacts. And as I mentioned before, if you've never done this before, it can, and it's a small industry, so it'll be helpful to you to have a consultant shepherd you through the process. Sometimes if you start certain things too early, you can increase your cost. So thinking of having somebody that has done it before and help you shepherd you through the process, a consultant is very helpful.
Hey, I'm sorry, but I do have to run. I have another event that's backed up to this. So I really appreciate everybody's participation and would be happy for you to reach out to me for more questions.
We absolutely want to thank you, Monica and Ashley, for this presentation. And I want to remind everybody also that it's going to be recorded. Oh, well, it's actually being recorded as we speak, not going to be recorded. But it's important to remember that because that was one thing that helped me, was being able to watch these types of presentations over and over again until I really got the math and everything under my belt. So I thank you guys for participating in this webinar and helping us out.
And we'll send out, like I said before, the presentation. It may take a couple of days, but we'll get it sent out.
All right.
Thank you, Ashley.
All right, thank you, guys.
Thank y'all. Thank y'all so much. And thank everybody that participated or came on to the site. Thank you.
Let us know if you have questions.